In the world of corporate finance, business valuation is an essential process that allows investors and managers to understand the real value of an entity, company, or corporation. Whether for mergers and acquisitions, for the issuance of shares, or for investment strategies, knowing the value of a company is essential, and valuation can also be applied to financial instruments, project evaluation, or business divisions. There are several valuation methods, each with its own characteristics and applications. Below, we explore the most used methods in the industry. One of these methods is the discounted cash flow valuation (DCF). The DCF method is widely recognized for its focus on future cash flows. The premise is that the value of a company is equal to the present value of the cash flows it is expected to generate in the future and includes in its most advanced form the perpetuity component of a financial flow. This method is particularly useful for companies with predictable and stable cash flows. However, it requires assumptions about growth and discount rates, which can introduce a degree of subjectivity into the valuation. This subjectivity must be examined especially when the valuation exercise has been carried out by one of the counterparties that caused the need for it, that is, by those interested in the sale or purchase of the company. Another method is the valuation by comparable multiples. This method involves comparing the company with similar companies in terms of financial multiples, such as per stock price divided by earnings or enterprise value divided by EBITDA. It is a quick and easy-to-understand method, but its accuracy depends on the availability of comparable companies, the availability of financial information on those companies, and the relevance of the multiples used. The third is valuation by previous transactions. The valuation by previous transactions analyzes prices paid by similar companies in recent purchase and sale operations. This approach provides a market-based valuation basis, but may be influenced by specific market conditions at the time of that preceding sale or by the unique nature of each transaction, for example by urgent needs to close the sale of one of the counterparties. Now let's talk about the valuation by liquidation value method. This method calculates the value of a company based on what it could get if all of its assets were sold and all of its debts were paid. It is a conservative approach that is often used for companies in difficulty or in liquidation. Finally, we have valuation for substantial method, value. Substantial value is based on the book value of the company's net assets. Although this method may be useful for companies with large amounts of tangible assets, it may not reflect the true value of companies with significant intangibles or with service-based business models. In conclusion, choosing the appropriate valuation method depends on several factors, including the purpose of the valuation, the nature of the company, and the information available. Analysts often use a combination of methods to arrive at a more accurate estimate of value. Ultimately, valuation is as much an art as it is a science, requiring expert judgment to correctly interpret data and market trends. We are sure that after this video you will want to learn more about business valuation. That is why we invite you to watch our next video, in which we will go in depth about the most used method, which is discounted cash flow valuation (DCF), its application, and some necessary knowledge that revolves around the use of this method. Until next time.